Okay, good morning, everybody. Thank you for taking time and making this a priority in your day today. We really appreciate that. We know that the real estate that resides between your ears is of extreme value, and you giving us some time to share with you is very much appreciated. As you may know, the topic today, or the title of our symposium, is Evolving for the Future, Technology-Enabled and Value-Driven. The operative word is evolving. The world is evolving very rapidly. As we know, our industry is being impacted and innovations are creating convergence. A lot of the benefits and the various services that we deliver are converging around a center. That center, it has a gravitational force that's largely driven by the needs of the 2024 workforce, which is creating a really strong pull towards the center. And what's happening is that these things at the edges are slowly getting drawn together, but you know how it works, kind of, it happens slowly and then all together very quickly all at once. And so that convergence is quite disruptive to both advisors and employers, and certainly for plan members, so not just both, but to all the stakeholders in our industry. It can be quite disruptive and disconcerting to many as well. I participated in a symposium recently with the Canadian Pension Benefits Institute and asked the question, and it was quite remarkable that the number of people in the crowd who were willing to acknowledge that they feel overwhelmed by the amount of convergence going on in our industry and how to navigate effective HR management and, for that matter, advisory services to the employment world. At IDC Win Workplace Solutions, we are a full service group MGA, and we're committed to supporting advisors and your clients in navigating and finding the signals in the noise of all of this convergence. Today, we have a terrific lineup of thought leaders who'll be presenting. We hope that you find some of the information compelling, certainly exciting, and helpful. And as we move forward, a lot of innovation is not necessarily just the technology. It's around language, it's around consulting, finding the right ways to speak to our customers about a lot of the change that's going on. That's really where it starts. It removes a lot of the angst, is being able to have a solid conversation with customers about what their needs are and what kinds of solutions are actually becoming available to serve those needs. We're here to support. I hope that today will help to define some of the language for you, some of the ideas for you, may provide you with opportunities to differentiate yourselves as advisors in the marketplace. And we are certainly here. We have business development people now across the country, and we're here to support you as you seek to catch up or hone your consulting capabilities for 2024 and going forward. So we're going to be introducing Scott and Dom. Our first session is with regard to Bitcoin in the workplace. So as Scott and Dom join us, please note that there's going to be a couple of questions in a poll, really easy questions for you to answer. If you could answer those, we'd very much appreciate that. So really quickly, I'll start with Scott Dedels. Scott has actually worked in our industry. He was with one of the big three insurance companies for a number of years, in senior roles on the marketing side. He then took his experience both with benefits and Bitcoin and has created a company called Block Rewards, where his agenda is to provide education and adoption of Bitcoin in the workplace. I had the good fortune of listening to a podcast that Scott's got, and I'd strongly recommend you find it. Scott, you can mention, I think it's called Block Rewards, actually, the podcast, but Scott, you can mention in a minute. But I listened to one of his podcasts where he had a chat with Dom Bay. So Dom is the founder of Proof of Workforce, which is a 501c4 nonprofit. He's a 15-year firefighter and former president of the Santa Monica Firefighters Union, and he was instrumental in working to secure adoption by his union of Bitcoin in their strategies. So this promises to be a really, really exciting conversation, and I'm going to kick it off really quickly with a couple of questions. I was recently listening to an interview, I think it was a podcast as well, with Peter Diamandis and Kathy Wood from ARK Invest. And I think Peter asked a question of Kathy, and I think it's worthwhile kicking this conversation off, is, has Bitcoin achieved some kind of asset status, recognized asset status, to the extent that it becomes a fiduciary responsibility today for pension funds and for consultants to, advisors to, employers, and actually to all customers? Is it a responsibility, a fiduciary responsibility for advisors and pension funds to integrate Bitcoin into their advisory processes? So I can kick it off. Scott, if you want to take it first, go for it, and then it'd be good to hear Dom's view on that question as well.
Sure. Thanks, David, and good morning, everybody. It's a pleasure to have an opportunity to be on here today, talk about Bitcoin. And so to start with the question of, do I think we've reached a point where, at a minimum, having conversations with clients about Bitcoin has become a fiduciary responsibility? Personally, I'm going to spoil the outcome of today's presentation. I'm a Bitcoin bull. After hours of study and years in the industry, and I maybe just start with a little bit of a missing piece in my bio, which I think is relevant. When I left my role working for a major insurer, I moved into private consulting, and I was an advisor myself for 6 or 7 years, and did do quite a decent amount of pension business myself during that time. And I actually discovered Bitcoin in the spring of 2020 when the economy shut down. I was trying to understand for myself what the impact of what I thought at the time was really sort of an unprecedented level of government spending would be on the purchasing power of the Canadian dollar, and more specifically, the bond portfolio component inside the pensions I was managing. So I wasn't actually interested in Bitcoin. I wasn't looking for Bitcoin. I spent the early part of lockdown watching Prime Minister Trudeau's daily announcements, and then reading economics textbooks that I had ordered off Amazon. And after I had ordered a handful, I was actually recommended a Bitcoin book based on things I'd already purchased. So to put into how relevant is Bitcoin today? You know, I think of Bitcoin sort of as the proverbial objects in the rearview mirror are closer than they appear. And it's a technology that has been moving at an incredibly fast pace of adoption in the entirety of the time it's existed. It's just that when you're starting from, say, zero, I think a lot of Bitcoin sort of early moves went largely unnoticed or really weren't taken seriously. And this year, we have seen a significant change, I think, both in the status and the perception of the quality of Bitcoin as an asset, and particularly as an institutional grade asset. We had Canadian Bitcoin spot ETFs launch in early 2021 with not a massive amount of fanfare, but the US spot price ETFs that were announced in January, that's different. The US is by far the largest capital market in the world, and the US Bitcoin ETFs have been the most successful ETF launches in history. So the narrative, prior to January, I think, has been a lot of, Bitcoin is retail. This is not something that you're going to see, institutional class investors really taking seriously. And we've seen in the first 5 months of 2024, that's really not true. And the IBIT BlackRock Bitcoin ETF has been their best performing fund, has been their most successful launch ever. And it's a performance-driven market. So what I think is interesting, as we see more Bitcoin ETFs come in, we're really watching the early stages of doors for capital to enter into Bitcoin positions becoming easier and more accepted simultaneously. So at what point does Bitcoin become something where you're now not doing your job by not having a solid understanding of sort of what the value proposition is and why somebody or an organization would want to consider a position? That it's like kind of picking a moving target marker. By just about any measurement, Bitcoin is the best performing asset ever. Certainly in the time that has existed, it definitely has been. And we'll get into some of the more, the nuts and bolts of exactly how much. But I think, yeah, I think the answer is yes. So there's maybe just to put a bow on that idea. One side of it is we have seen a rapid expansion of the different ETF products in the US market, but additionally, the first Bitcoin ETF spot price launched in Australia yesterday. There are a number that are in the approval process in Asia, Korea, Hong Kong. We'll see, I think we'll continue to see more institutions want to have access to this product as it continues to draw capital in. And on the other side is really understanding that Bitcoin has a, we're going to talk about what kind of an asset it is, but the functionality of what Bitcoin does really is an idea that has arrived just in time for the monetary conditions that we're probably heading into over the next 10 and 20 years and beyond. So my long-winded answer to that is yes.
Dave, I'll jump in here, and so great to be on here, and everyone that's in the audience. I really appreciate this opportunity to be here. So, yeah, to add on to that question, Bitcoin, right, since its inception, has proven itself time and time again as an effective store of value. It's been declared dead dozens of times by the mainstream media, right? Bitcoin's going to zero. It hasn't happened. It's continued to bounce back and reach new all-time highs and proven, its ability to navigate cycles, et cetera. Is it a fiduciary responsibility? Has it proven itself as being a fiduciary responsibility? I wholeheartedly say yes, it has, for a couple of main reasons. Number one, and we'll talk about it later, the 25th largest pension in the world, the 10th largest in the United States, the Wisconsin retirement system, one of the most well-run, well-funded pensions in the US, recently announced that they have 0.1% of their portfolio in various Bitcoin ETFs. So the flip side of that coin into, is it a fiduciary responsibility, is it's no longer a fiduciary liability to allocate to Bitcoin, because you have one of the best funded pensions that has done so. And as a fund manager, you can easily point to this pension and go, look, I'm peer comparables are a actual tool in managing a fund, and you can point to that fund. Additionally, the Houston Firefighters Pension Fund, another very well managed fund, also was the first to allocate to Bitcoin. So you can point to these and you have a reduction in the liability. Another layer into why it's a fiduciary responsibility, the participants of these pension and retirement funds are finding Bitcoin on their own before the funds that they're entrusting to protect their retirement are. And so it is a responsibility, because what you can have, especially in the US, is imagine telling pension participants, hey, bad news. You're not retiring anymore at 55. We're going to move that to 60, and we need you to contribute into this fund because we're not performing and keeping up with liabilities. For them to respond and say, I've found Bitcoin, which is built for this financial environment to keep pace with liabilities, and you haven't looked into this. So now as a participant, did you breach the fiduciary responsibility to look into this thing when you're also simultaneously asking me now to work longer and contribute more money? So those are two very compelling reasons why I think fund managers should 100% have some kind of due diligence on Bitcoin on file.
So I'm going to throw it over to you. I know that you had some conversational topics that you wanted to bring up with Dom as well. Do you want to take it from here?
Sure. Yeah. So Dom and I are going to sort of have a little bit of a fireside chat to walk through, a high level overview of the kinds of things we think are relevant for the conversation around Bitcoin and its place and role, what the considerations for Bitcoin in group retirement savings plans. And maybe Dom, I'll just start at the start. And in your own words, could you sort of phrase the what is the argument for Bitcoin having a place inside a pension allocation?
Absolutely. Well, first, you can't bypass what is the purpose of Bitcoin serving the workforce or wage earners, right? And some of those things we've seen in the dialogue since Bitcoin's inception, right, is, the fact that it is scarce, the fact that you can, hold it yourself in self-custody and it cannot be confiscated, so to say. We do have mechanisms now for pension funds, but for the worker, Bitcoin is an ability to protect purchasing power. It is not debated that if you keep, cash underneath your bed, that it loses purchasing power. No one says, oh, that's not true. That's not debatable. There may be varying degrees where people argue over inflation being at 2% or real inflation being at 5 or 10%, but no one sits there and goes, no, you're good. Keep the cash under the bed. You won't lose funds. So it's important to the worker. And if it is important to the worker as a tool to preserve, purchasing power and protect the time that they're trading for wages, then it is also important for pension systems, which is the larger trade-off of time for a retirement, right? So short term, 9 to 5, we're trading our time for an honest living so we can take care of our family and purchase things we need. Long term, we trade a 30-year career in the hope that we'll be able to retire during our later years when it's much more difficult and painful for us to work, especially folks that have, I'm a firefighter. And so, imagining I already got some aches and pains at 40, but at 55 and 60, like those are going to be exacerbated running into a burning building, et cetera. So they have a place in pension funds. Another key reason why I believe they have a place in pension funds, and at least I know this may not be as big an issue in Canada, but for sure it was in the US, was if you look at the financial crisis in 07 and 08, the average funding status for pensions went from the low 90% on average for state and municipal pensions to the low 70s, high 60s on average. The key thing is they have not recovered. That you would expect in the longest equity bull run in history that recovery would be robust, that the average funding status of pensions would have been, back to the 90s. That didn't occur. And so Bitcoin for sure has a place in pension funds as, an allocation mechanism and an asset allocation class that can help buoy pensions and help them keep pace with these liabilities that are outpacing the pension's ability to maintain that funding status.
Scott, can I ask a question? Do you mind if I throw a question out just to clarification on something Dom said? When we talk about store of purchasing power, I know that for me as well, I find it a little bit disconcerting in that the volatility seems to be a counterintuitive kind of proof that store of purchasing power in Bitcoin, or it implies that the store of purchasing power in Bitcoin is not a reality. So how do you reconcile the two of volatility versus store of purchasing power? Short-term volatility, I guess, long-term. Do you have a comment on that at all? Either one of you.
I can jump on that super quick, and I know Scott can. So I think we're talking short-term, long-term purchasing power, right? So you get a paycheck on a Friday. You're going to buy what you need, whether you get paid in Bitcoin or dollars. You're going to buy the necessary things you need right then, right there. Boom, you purchase those things. Whatever you're left with, you're looking at potentially saving that. The purchasing power for Bitcoin, yes, there's volatility. It is a long-term purchasing power savings mechanism. And we've seen that in that anyone that's held Bitcoin over the length of one cycle has always been in the green, regardless of the volatility. So That is a valid observation, David. And you know, for sure, if you are saving money for something you're going to buy in 6 months, you need to be cognizant of the fact that you could have volatility. But if you are saving purchasing power for long-term large purchases, as long as you have a good time horizon of a cycle, you're going to be okay and in a good position. And again, we can get into a much deeper conversation of Bitcoin's reflection, its volatility, of the volatility of markets of, like, in general, because at the end of the day, you always have the same amount of Bitcoin that you have. But yes, the value will fluctuate based on conditions.
I think that you know, it's important. A few different points to touch on there. One would definitely be volatility on its own is not a bad thing, and it's often, you know, it's sort of a requirement for alpha. So Bitcoin's price has a history of significant drawdowns, which get a lot of press, but that has really come hand in hand with it having a compound annual growth rate, depending on your time measurement, somewhere between 40 and 60%. So you know, I think, and if we're talking about pension considerations, it has more to do with the sizing of the position and the time horizon of you know, of the liability. So maybe a few more things. I think if I wanted to tack on to the first question around the argument of Bitcoin for pensions, one, Bitcoin has a low correlation historically with traditional assets. So it represents a way for pensions to potentially access a high performing asset that at the same time has sort of not performed hand in hand with stocks, bonds, real estate, etc., which could be and we'll show a little bit of a model later on. It's an important tool for smoothing out returns, actually. And I think that the second important part to consider, relating back to what I was saying earlier about the multiplying number of ways for institutions to consider holding a Bitcoin position. So we've seen now a handful of pensions make minuscule allocations in the grand scheme of things to Bitcoin. So Wisconsin, as Dom mentioned, has a $160 billion pension, and they made a 0.1% allocation. So that's one pension buying a tiny allocation to start. Now, Bitcoin is unique as a commodity in that it has a no reflexivity between the demand and the supply. So Bitcoin has a inelastic supply because of its permanently fixed amount. So as more money theoretically can come in to use Bitcoin as a store of value asset, there is no ability to dilute the amount of Bitcoin or increase the rate of Bitcoin that are available for the market to buy, which is sort of makes it a little bit of a, you know, it's designed to be sort of a capital sponge for weaker performing assets to flow into harder ones. So Bitcoin as a growth potential asset offers funds a lot of potential yet, because Bitcoin today is somewhere around $1 trillion market cap, which is smaller than companies like Google and Apple. Bitcoin is still not even as big as some of the biggest companies in the world. There often, I think, can be a little bit of a unit bias when it comes to trying to evaluate the risk reward of the future return potential of Bitcoin, because the price in dollars is already, you know, reached a number is much higher than what it was 4 years ago or 8 years ago. But that sort of kind of obscure the fact that relatively speaking, compared to other assets or even large companies, Bitcoin is very small. Bitcoin is as a comparison on the commodity side, gold is you know, between 12 and 15 times larger market capitalization than Bitcoin. And the gold one is meaningful because Bitcoin has an important narrative, as Dom mentioned, as a store of value, sort of digital gold narrative. So I think it's really important, and I would say that, big theme for the day, I would suggest that investment conditions are structurally changing. It has to do with a lot of different factors. Technology is advancing, the way we do business is changing, and the way money works is also going to be different over the next 20 years than it has been over the past 50 years. And I don't want to spoil too much from my second presentation this afternoon, but we've seen the changing monetary conditions already evolve the way pensions think about managing their portfolios. And in the UK, 2 years ago, there was a massive blow up that nearly bankrupted, I think, around 50 pensions due to an LDI strategy where they were having to leverage their own holdings to meet the minimum requirements for returns. And we've seen similar things in Canada, not identical, but it's true to say that the large Canadian pensions have had to consider getting increasingly riskier with their allocation decisions over the last 20, 50 years, however you want to call it. And it has to do with the ongoing challenge of achieving a positive real rate of return. So I think that those are all important things to consider. And the last one is that portfolio allocations have always changed, and they will always continue to change. So there was a time when Ontario Teachers' Pension was a 100% allocation to Ontario provincial bonds. That's true. And that was a pivot, a gradual move away from that strategy to what now is something that has included a number of sort of cutting edge and very unusual looking investment decisions that have, for the most part, worked out well. But I think that's the last piece I think to really consider is that we're going to have to consider new ideas as the markets continue to evolve, just like anything else.
Scott, a question actually is on, I'm not sure both of you can maybe take this one. Dom, you want to take it first? I know that your union had considered or has created an allocation to include Bitcoin, but to your point on the Wisconsin pension, 1/10 of 1%, and Scott, this kind of draws back to some of what you were saying in terms of the volatility and the growth rates. But I'm pretty sure it is, but maybe you could just expand on the notion that even a 1/10 of 1% allocation to a pension fund that's 160 billion, while it might be 1/10 of 1% right now, would they have been modeling a view forward where even just that 1/10 of 1% is through Bitcoin's projected growth rates over time would achieve X% of that fund over time? Does that make sense? Is the question even a sensible question? Either one of you could grab the one.
I can jump in there real quick. The percentage, obviously we know that the asset allocation policy and strategies of pensions and retirement funds vary widely, across local municipalities, states, employers, etc. What their parameters are on this allocation, whether they've retooled some stuff, that's, internal things that the general public just doesn't know. I think, of course, what we found, we have myself and a few others, we do this show where we have pension funds come on and we model Bitcoin in their portfolio to see how it adjusted. So I think what you're getting at is it is a small allocation, but Bitcoin, if it performs as it has performed, has the ability to become a much larger percentage of the portfolio, 100%. I think the small allocation for those listening and the fund managers listening on here, I think the small allocation is more of a test of public sentiment than it is on whether the asset, how it's going to perform, and trying to monitor it. I believe that most likely they already have an idea and a lot of due diligence on how Bitcoin should and could perform over a long term, and they have the horizon set. The big question is, and I feel for all the fund managers, I get it. There's been 10 years of negative media coverage on Bitcoin, right? Every hiccup. Bitcoin's a scam. Bitcoin's going to zero. Someone lost $1 million in Bitcoin in their wallet. You hear about every bad thing. People can riddle it off. FTX was so widely covered. Everyone's heard it. I understand the career risk. I think for a fund like Wisconsin, that small allocation is more of a test to go, hey, y'all, we're pretty safe from getting ridiculed or having career risk because we're such a well-run pension that this is such a small percent that if we lost everything, it will not impact our overall mission. What we're curious about is what's the public reaction going to be? We want to see how are they going to feel this out. And this aligns with a lot of the work we do with local unions in that start with a small get off zero approach, see what the response is, take away the emotion and the fear, give yourself some good padding and protection, and then allow the stakeholders to decide moving forward, which I think you'll see in Wisconsin. Hey, we love the move. Great. But let's do something more meaningful, a percentage that will, impact the portfolio big time for years. So I think that's where they're at with the small allocation. And yes, they can track performance and see how it becomes a bigger portion, or potentially they have to reallocate based on their parameters. But that's what I think they're really testing over there.
And maybe to jump in on that too, I think also it partly because they're if you're not really paying attention to Bitcoin, you might not notice exactly how significantly it is outperforming the market and most other assets, and particularly say indexes. So can something that is, if your portfolio is returning 7%, and then you have one asset that's returning 60%, for sure, over a short period of time, a 1% allocation as a percentage of your total portfolio is going to become 5, and then it'll become 10, and this is something that actually has played out. Dom mentioned the portfolio modeling tool that they use on Nakamoto Gauntlet, and they did actually run the model for Ontario teachers, which I think is interesting, and I'll just highlight some of the data that they pulled out of it. So over the 8-year period between 2016 and 2023, the total return of Ontario teachers was 42%, so an average of around 4% per year. And that had a historical volatility during that time of 11%. So what they modeled out were a few different scenarios: Bitcoin position of 1%, 2%, 5%, and a 5% allocation to Bitcoin move that's 8-year return from 42% total to 102%. So that's just a single 5% allocation to Bitcoin more than doubled the overall performance of the entire fund. So it's not a small thing, and this is where I think, to Dom's point around where you're seeing funds start to test the water. There, as we know, there's a lot that goes into making a position decision like this, and should Bitcoin continue to do what it's done historically, or even if it just remains among the best performing assets, it's creating its own compelling case for other pensions to have to consider doing the same.
Yeah, for sure. One quick thing on Scott's point, it's also serving that function with a lot of the union funds that I work with. And for example, in our own union, a very small allocation as a reserve asset for a fund that's for just an emergency situation or something we don't foresee in the future. With just 4 to 5 months of holding Bitcoin, we outperformed what we used to hold in CDs, 10 years worth of returns on that in 4 months. Now, like you said, David, it's volatile and it can go up and down, but Bitcoin doesn't have to perform for pension funds the way that it performed for the individual that picked up Bitcoin in 2013 with these massive gains. It just has to perform and outperform other investments that we've shown that aren't built to run well in this current fiscal environment. That's all. So pension funds don't, that's just a bonus. If Bitcoin, performs like it has in the past and has these massive returns, they have the ability to buoy the whole portfolio, but it doesn't have to do that. Bitcoin can simply just have, significant returns that outpace some of the other things we're seeing for it to positively impact the pension fund. And then, of course, we've seen that the volatility on the downside, because the allocation is small, does not impact the fund as significantly as when you have the upside.
And to just touch on that, that's a great segue, Dom. There was a question that came in and the bar I saw there. What did the 5% allocation to Bitcoin do to the overall volatility of the fund during that model time, which was originally 11.2%, and that 5% allocation to Bitcoin took it up only to 12.04%. So you made this point earlier, Dom. I think what we see in the media is the negative stuff, which I think is obviously partly by design. Certainly before the major institutions had any ability to make money managing Bitcoin. And this is also something that we've really seen change, and why I also think advisors need to be very aware of Bitcoin is now that you have BlackRock, for example, having some skin in the game, you have really seen a market shift in the kinds of advertisements you're going to see even on television about Bitcoin. And like if you're interested, you just go to YouTube and start watching Fidelity's Bitcoin TV commercials that they're running, and they are very, very pro Bitcoin in a way that we weren't seeing these even 3 years ago. There was one on during a Laker game, commercial during a Laker game the other day, and it was so astoundingly pro Bitcoin. I almost had to I couldn't believe it was on TV.
And you know what? Your poll, David, can you pull up that poll again that you ran on the whether Bitcoin will disrupt financial markets? Okay, so this is a perfect evidence, not direct. I won't say it's directly related to the negative media, but look at this question here. Will Bitcoin disrupt the monetary system? A majority says yes, 63%. However, the conversations from the clients are 35% about this thing. And so, right, there's a disconnect there. And I bet you the clients that aren't asking about Bitcoin would still say, yes, I think it will disrupt the system. But there's been so much negative media that they go, yeah, it's going to disrupt the system, but I don't want to get near it because I'm afraid, So, because that doesn't make sense. If you tell me something will disrupt the monetary system, then for sure people should be calling about it and asking, are we looking into this? So it kind of goes back to that. I think there's a consensus around Bitcoin being a store of value, being the best of, digital assets. The world as we know it is becoming more digital every day. I think that's another thing that people agree on, whether they like it or not. I still love the real world. I like getting outside more, but the time for due diligence is here. There's more resources available now than there ever was. Scott mentioned it, our show, we have fund managers on our show at no cost, and they walk away with a pro forma due diligence kind of little report for their file that is very sophisticated and high end. So there's not really, the excuses are running out for why a fund doesn't have any due diligence on file for this. I'm not saying they have to buy it. I'm just saying look at it and do the due diligence.
Scott, can I take it? Can I add a question here? So I just was listening again to Michael Saylor. I know it was last night, but a couple of things I've been listening with him, and he was talking about the fact that, is Bitcoin a currency? Is it a property? There's a whole. So I guess on one level, and just another point in terms of money, Andy Edstrom's book, Why Buy Bitcoin? By the way, for folks listening, it's an outstanding, easy read. And Andy Edstrom had years and years of experience on Wall Street. And he acknowledged, he's an economist by training, I believe. And I think in the book, he says something to the effect of, he worked in this industry for so many years, and his understanding of money was distilled down to maybe half a class in Economics 101, that money is a commodity that is a store of value and an exchange of value, or something like that. And that was the extent of it. And he didn't ever, so no one's actually even thought to understand what is fiat currency, what is money, how does it work, the whole thing. So my question here is should we expect Bitcoin to behave exactly the same way that we would if we consider Bitcoin as an investment asset? Should we expect it to behave exactly the same way, say, for instance, as stocks do or fiat currencies do? What kind of asset do we even make a comparison to? And to throw your question back at you, Scott, because I'm not sure I've ever heard you answer this, and Dom, you might want to do the same thing. Starting with, what is Bitcoin? Just very briefly, because we could have that conversation. What is Bitcoin to you? And how should advisors be considering it in terms of an asset and how it should perform?
Yeah, I'd love to take a stab at that. I think there are a lot of different ways to conceptualize what Bitcoin is and what it does. And, you know, a challenge that people have is this term cryptocurrency, which personally myself I don't love it. It's a little bit of a distraction. Does Bitcoin need to be a currency to be a success? Is an entirely other conversation around, which is really a sidebar to what we're talking about now. Because today's conversation is really about, is this something that group retirement plans should consider, or advisors should understand, like, if they're not, what relevance does it have? And in this context, I think what we're talking about is Bitcoin could be thought of as a synthetic commodity. It's a commodity that has been engineered to have transparent properties. And one of those properties is that it has a finite amount. So it's the world's only truly finite commodity, and it happens to be physically intangible. But the exchange for it being physically intangible is that it is infinitely divisible and it is uniformly measurable. So it is this thing that we can't physically hold, but we can subdivide with a tremendous amount of accuracy. And it also means that it is sort of, because it's digital, it can be transported anywhere in the world. So it is something that is international, and it is fully liquid. So in addition to being kind of quantifiable. And so as a commodity, it's really well thought of as being property. And could that property, evolve into a form of money that we use as a currency? Sure. I think, lots of things become money over time or have the properties of money. Baseball cards, real estate, one of the things that money tries to do for us is store value. And we've talked a lot about storing value. So Bitcoin absolutely already does that now. It's storing over $1 trillion of value. People are using it for that function. In Canada, the CRA treats Bitcoin as a commodity. The Canadian Securities Administrators treat Bitcoin as a commodity. This really isn't something that is sort of part of an ongoing debate. Bitcoin is the U.S. Commodity Futures Trading Commission treats Bitcoin as a commodity. And this is because Bitcoin doesn't have there's no company that is behind the issuance of Bitcoin. Bitcoin is not a business. It is a protocol that runs on a distributed basis through anyone who wants to participate in running it. And the result of this network of people all over the world is this sort of intangible digital commodity, which can be used as property. And some people are using that property as a way to store their value. So long answer, but that's sort of how I would think about it.
And being the firefighter in me, I'll add on to what Scott's saying in a very low tech form, and not to do any disservice to Bitcoin, but the digital asset side of Bitcoin is only one facet of it, which Scott pointed out so well. It's one aspect of it. Bitcoin came together as a peer-to-peer money system, a digital money system, right, that people could use and transact with each other. So just a reminder for people listening, we're focused right now on Bitcoin's scarcity, which is one component of it, and the fact that it's a digital asset that is scarce. But we have to remember, Bitcoin is also the largest decentralized computer network in the world. that exchanges, right, monetary transactions and data and information with no CEO, no staff. They have no employers. It is just an open source, decentralized protocol that is the largest in the world. And so, again, when we ask ourselves, is the world becoming more digital or less digital? A lot of people respond to that by saying, I think it's becoming more digital. I think you can learn a lot more from me by taking my phone and computer and reading everything through it than you could if I went through your house and looked through your drawers and found what little old school notes you used to write people in high school, right? I can learn a ton about you. So there's consensus around that. And Bitcoin is built for the digital age. And when anyone thinks of what is the most famous, successful digital money of all time, the answer is Bitcoin. So the asset side is only one facet, but there's tons of stuff going on simultaneously with Bitcoin as a technological innovation that is occurring as we speak on this space right now. People are building tools for the future on Bitcoin.
And that's a good point, Dom. I think this is also something that is unique about Bitcoin in that it offers this sort of store of value functionality, combining that with the growth potential of a network effect. And the network effect relates to internet native money. So Bitcoin as a medium of exchange does provide people who are using it for that reason the ability to do things that they can't do with legacy financial and the SWIFT banking system. So you can send $1 billion of Bitcoin for a couple of bucks in a matter of minutes anywhere in the world with no clearinghouse, no holds, no verification of the receiver on the other end. There's no KYC. These are things that will become very valuable to international business or nation states. So I think a huge use case that is in the process of proving itself out for Bitcoin that will be meaningful for holders of Bitcoin happened when the United States government made the decision to freeze US treasuries held by Russian banks at the outset of the Ukraine war. So Bitcoin, another one of its features is that it is uncensorable and unconfiscatable. And so US treasuries as a balance sheet asset for nation states took a big, the appeal of them took a big hit when the United States made that decision to freeze those assets. And so how long into the distant future are countries that may want to have autonomy over their own political strategy, they're going to be probably less and less likely to want to hold US treasuries or any more than they absolutely need to. And so they're going to have to hold something else instead. And it certainly could be some basket of commodities, but this is also why I sort of pointed that consideration that, on its own, Bitcoin is a commodity. So it does present a compelling case for central banks, for different central banks to consider holding some. It won't be Canada. And Bank of Canada doesn't even own a single ounce of gold, but that's maybe a conversation for another day.
And that's a compelling interlude into our conversation, specifically around pension plans and planning for utility of Bitcoin in that world, in retirement planning, etc. Just in terms of its efficacy, its use case, etc., and its value in the world. But there's a very practical question here from Ken McCoy, and I see Dom was already typing an answer, but I think it's really practical. It might be a really good question for us to bring this, to take us to the end of this hour. So Ken says, I agree that Bitcoin is a good option for pensions on a long-term basis. However, many individuals are investing to enhance their retirement income. Personally, perhaps a 40-year-old may benefit because he has time on his side, but I would not think it would be a good option for someone in their mid to late 60s who has very little savings. Your comments, please. So it's a context of, timing, etc., and utility of Bitcoin in a very practical way.
Yeah, I was just typing a response to this so I can kind of kick that off, but great point by Ken. And, older individuals that are either closer to retirement or in retirement, they have to consider the volatility of Bitcoin and what they need as far as their immediate, near, midterm, and long-term future. However, 100% valid, well put by Ken, and a consideration. However, as far as things like estate planning, long-term wealth, we all always thinks of things that we're going to hand to, our kids, our grandkids. Bitcoin still does have the ability to serve older individuals with small amounts of savings that they can afford to basically, that aren't necessary in the near or midterm. And additionally, Bernie Sanders said in one of the committees on health and labor and retirement that we're in a retirement crisis in the United States as far as Social Security, et cetera, like that. So there is the component of Bitcoin of self-custody, where even if and there's also no barrier to entry. So unlike a stock that may cost, $80 for a share, you can put $1 into Bitcoin right now. And sure, it's not going to change your life, but that's $1 of Bitcoin that you hold yourself, that cannot be taken away from you by the government or the benefits administration or whatever happens with that third party that controls whatever you're doing. And it is something that historically has shown that it will maintain and grow in value over time. So there is still a strategy for older individuals to have a savings mechanism that they can keep. It cannot be taken from them. And it can be passed down to, the next generation. But I agree with Ken 100%. If you need money, you should not be, the strategy shouldn't be, I'm going to put 20% of my entire savings account that I need next year because I hope it's going to go up by this amount. And now I can buy, instead of, one trip, I can take 2 trips. That's not a smart strategy. And Ken points that out well there.
So it's a question of allocation. And what you're making the argument for on balance, Dom, is that some element of allocation, even at that age, is still probably a good idea.
Yeah, I've seen this in traveling abroad a lot. I've done a lot of trips to El Salvador, where, as you can imagine, the threshold for what they can afford to lose is so narrow. Let's just say, for example, you make $100 in a week in El Salvador, and you literally have to spend $99 at that time for, needs that you have. What do you do with that $1? There's no incentive in some of these countries to save it all, because that dollar is only worth 50 cents in like 3 or 4 years. However, they don't have access to stocks. Also when you're older, it's tough to pick stocks. You don't want to gamble on winners and losers, et cetera. And so as a savings mechanism for small amounts of disposable savings, we're not talking about making it rich in our later years. We're talking about what are we handing down to the next generation of value with what we can afford to lose. So yeah, 100% different strategies for someone who maybe is 25 entering the workforce, and what can they can afford as far as risk wise, and someone who's 60 who's about to retire or in retirement.
Nice. I think it's also a question of how long are you planning to live? So if you're in your 60s and Bitcoin continues to perform as it has, or even anywhere near it, and you do manage to live into your 80s or even your 90s, compound annual growth rate with a 40% CAGR is going to be a meaningful number. It's the same concept that we were talking about. Portfolio allocations and pensions applies to people later in retirement too. So yeah, I think it's just about right sizing based on time horizon and volatility.
Guys, I want to say this has been an absolutely outstanding conversation. I really hope that the audience has found value today. Clearly, Bitcoin is not something to be taken lightly. I think, again, Michael Saylor, who's many people's guru when it comes to Bitcoin, he says something like, you got to spend an initial 3 hours just to kind of scratch the surface. You get to 100 hours of learning, and the penny should drop. You'll be as proverbially green-pilled. We certainly can't answer all the questions here. I think that the key, I think Dom would agree with us and Scott would agree with us. The key here is education at the moment. Adoption will come, but it's so important that people get to understand what Bitcoin is, where it fits in the world, why it's such a disruptive force, and what it's looking to disrupt and solve for. and then we can start to understand value long term. But other than that, if we've got, I think, 2 minutes left on this one. Any closing comments? Scott, we can start with you, and then Dom, maybe you can finish off.
Sure. I would say, you know, as an industry person myself, this is why I enjoy the opportunity to do this stuff, because I feel very strongly that Bitcoin is an enduring, this is going to be a part of people's financial planning. And this is for individual households as well as sort of at the corporate level. This is, the more you learn about Bitcoin, the more you understand that it has a very, you know, at this point, it has as high a likelihood of being around in 10 years as the internet does. And anything could happen, you know, an asteroid could hit tomorrow. But short of that, as long as the internet exists, Bitcoin is probably going to exist. So it's something that people who are serious about having a career in financial services longer than 2 years from now really should be trying to dig into that.
Yeah, I'll just say real quickly, the reason I started Proof of Workforce was because I didn't want to sell people on Bitcoin. I wanted to educate people on Bitcoin. I'm sure Scott feels the same way, along with tons of Bitcoiners in the space that work all over the world. There's plenty of people willing to do that. We're here. The time is now for due diligence as a fund manager. If you know people that are in a union or manage a pension, there are plenty of ways to get the education on book. Again, they don't have to buy Bitcoin. It's just that the time to learn about it and have some due diligence. Don't let the opportunity pass by where the negative media kind of convince you to just dismiss this thing. And then in 10 years, you're referring to it as the lost decade of, you know, prosperity as far as how Bitcoin can perform as an asset. Look into it yourself, do the work, do the due diligence. Whether you decide to get into it or not, I promise it's going to be a beneficial journey. You're going to learn a ton and you'll be better for it.
Gentlemen, thank you so much. I think folks that want to, you can find Scott at blockrewards.com, Scott.
.ca.
And Dom, you can find him at proofofworkforce.org. Also the Nakamoto Gauntlet, you could look that up. There are a ton of other resources. We encourage you to get out there and learn and drive forward in terms of the Bitcoin world and see how it can work for you and your clients. Guys, thank you so much for this. And I guess we're going to move on to the next session.
Thanks, David. Thanks, Scott. And thanks everyone listening.
Thank you.